Welcome, guys. Welcome. How are you guys doing? We are starting the live broadcast right now. How are you guys? I hope you're all doing great. We're just gonna start our live broadcast transmission. Yes. How you guys doing? So we're gonna be talking about some finance essentials. Um, So before we start, guys, make sure that you follow, make sure that you share. My name is Smart Investor. Be sure to hit me with a sub. Basically, I am a young and upcoming investor myself, so I am very zealous about investment. So most of the time, you will find out that we're talking about investing stuff here. So today we're gonna just be talking about personal finance and investment. Okay, so personal finance has got to be the money that you earn, the money you save, the money you spend, the money you invest. So it's just an an umbrella for what you do with your finances. Okay, it's like an umbrella term. So there you go. I just set it up like that. Finance fundamentals. We're just going to talk about these ones. Of course, this is not my, this is someone else's work, but I'm just using it for reference because it covers everything I just want to talk about. Okay, so let's move on. So we get our agenda is we're gonna talk about what is investing. I've been talking about this for over 4 weeks. History, fundamental principles, and next steps. Okay, so there you go. I have a graphic up there, and yep, it's saying that investing is part of budgeting. Do you agree or you don't agree? Okay. Investing is a part of budgeting and consumer finance. So, yes, investing is part of budgeting money and it's also part of consumer finance. Okay, that is what investing is. So, first things first, we have save, we have cover fixed expenses, cover variable expenses, investment. So this is sort of like the life cycle of whenever we get our paycheck. Um, so this sort of like summarizes what we do with our money when we get our paycheck. Okay, I'm a bit under the weather, guys. So whenever we get our money, the first thing is, do you agree or you don't agree? Okay, do you save? Do you put money in your emergency fund savings account, or you go for to cover your fixed expenses? I'm thinking you cover your fixed expenses. Okay, whichever order you want to have those four in, it doesn't matter. Okay, it's not for everybody who has got their finances streamlined or in these four stages. Okay, some people might just have cover fixed expenses and cover variable expenses. Some people might not have invest, some people might not even have save, because it's based on your income levels as well, the money that you earn. Okay. So let's go there. So, but generally, when we are talking about people with a lot, with some sort of money, people with a good amount of disposable income, usually you're supposed to what to follow these four. Okay, save, emergency fund, savings account, have money for savings, cover your expenses, your bills, insurance, your taxes for sure. You need to cover those, and then cover variable expenses like your lifestyles. You want to eat, you have to buy groceries, clothing, and all those. That is why we talk about variable expenses, and then invest. Okay, so investing is assets and endeavors. So It's usually those 4 stages that we normally, if there are not any financial constraints or if there is not any problem, you get a good amount of money. Definitely, this is how you are supposed to spread out your finances. So there you go. Investing is part of budgeting and consumer finance. Okay. So we have a quote. I wish I had waited longer before I invested. Okay, this is a quote. I wish I had waited longer, or I wish I hadn't waited longer before I invested. Okay. So what is investing? We do have definitions there. What investing is about: the act of allocating resources, usually money, with the expectation of generating an income or a profit. So there you go. It's just an easy peasy definition. There you go. The act of allocating resources, usually money, the money that you earn. If you earn a good amount of money, it's allocating a portion of that good amount of money uh, with the expectation of generating an income or a profit. Like we always talked about last time, we are investing because we have long-term goals. Okay, we all have our objective. Okay, we all have our end goals. This is why we are investing. Okay, so personal to everyone. So investing should be personal to everyone. Everybody is under the right conditions. Everybody is expected to invest, because investing is important. You are sort of like preparing for the future. Okay, intended for long-term goals. Okay, you all have long-term goals. You and I have them, and at times your long-term goals will require some sort of financing. It will require some sort of financing, and then the investment becomes that vehicle that helps you to what, to take care of those long-term goals. Okay, especially in the financial space. So what is not investing? So we have a definition of investing, and we have a definition of what is not investing. Not a get rich quick scheme. Yes. So investing, you are buying assets, you're buying financial assets, you're understanding them, you're taking care of financial assets. Initially, when you begin to invest, you are growing your assets, understanding your assets. You should block away any idea or any persuasion of um, trying to quickly get rich. Okay, so it's like investing is kind of like having a baby, having a baby. Of course, it's going to be a newborn, it's going to be young, it's going to need to be fed. You're going to have to take care of your child, okay, to maybe send them to the best schools, maybe give them guidance, give them an education, okay. Make sure that you take care of their mental health, their physiological needs, something like that. Okay, it's not that you have a child in a day and you expect that child to be an adult tomorrow or to help you with stuff tomorrow. No, it doesn't work like that. So it's not a get rich quick scheme. Investing is not a one size fits all. Okay, so investing is a broad subject. Okay, there are many, like yesterday and recently. If you check some of my videos, I've been talking about the assets, the financial assets, or the asset classes. Okay, the asset classes. I did talk about the asset classes, that there's so many asset classes out there that a willing investor or someone who wants to invest may invest in. You can choose one or more asset classes to invest in. Some people are comfortable with only one asset class. Other people are comfortable with investing in a number of multiple asset classes. So that's how it works. Not a one size fits all. Okay. So investment is for all, but investment is different. It's from person to person. Okay. It depends on your understanding of investment. Okay. not a guarantee of a profit. Okay, it's not a guarantee of any profit, even though we have an expectation of having a profit. Like we always say, you always hear it, this in the world of investing, that investing, you're being paid to hold on to risk. So when you invest, when you buy equity, you're holding on to risk. You're not holding on to any profits or anything like that. You're holding on to risk, but also there's also that you're holding on to risk and also having an understanding that the company that you've invested in has got a strong core, has got a strong foundation. They have a what we call a proven track history. So we might be holding on to risk, but we inevitably, because of how the company has been operating and because of their track record and their history, that gives us enough assurance for the future that we might get a profit, we might get income. Okay, we might get asset or value appreciation for our asset. Okay, but in some instances it is not clear, it is not guaranteed. Okay, it's not like when you invest today, there is a guarantee of a profit, because the market is impacted or is affected by many other factors. Okay, like political, like government. Okay, all these things, they influence the investment market. Okay, uh, so let's go now. So now we know what investing is. So inevitably, when you hear statements like it's not a get rich quick scheme, it's actually challenging you to change your mindset when you decide to invest. It's also challenging you to delay. They talk about delayed gratification. Okay, to delay your gratification and focus on your asset, understanding your asset, stuff like that. So let's move on to now. Let's see what we have. Okay, 5 things that affect the value of your money. So we've got these 5 things that affect the value of your money. Okay, give me a second. I want to. Okay. I hope you guys can see me. So these are the 5 things that affect the value of your money. Okay, we have what? We have impact of taxes. Okay, we have the impact of taxes. Money, all money is, if you're a citizen of any country, all money is subject to taxation. Money that you earn. Okay, VAT, value added tax, and so many other taxes. Okay, money has got to be taxed. This is the economy that we live in. There's so many taxes from your salary being taxed. The government takes taxes, so that they what? Taxes are good to for improvement for the community, for the whole country. So impact of taxes. So taxes will affect your money, right? The more you earn, the more tax you get taxed. Okay. Yep. And also healthcare. Healthcare also is a is one of those things also that affect the value of our money as well, because we are always heavily investing in our healthcare. And try. There's also inflation. Okay, inflation also affects our money, the value. Okay, whether the money retains its value or loses its value. So inflation is one of those factors that also affect the value of our money. So value, simply by value, we mean purchasing power, the purchasing power of your money. Okay, what $5 buys today, maybe if you could buy, if what $5 buys today, if you could buy a bottle of Coke for $5 today, and in the next 3 years, you can buy that same bottle of Coke for $5.50. That means that inflation is affecting the money. Okay, the money no longer holds the value. It cannot buy that product, you could buy it for $5, but now you're buying it for $5.50. Now you're buying it for $6. It means that inflation has made the value of the money what go down. Okay, so low interest rates, exactly, low interest rates, and definitely we also have procrastination. Yeah, procrastination. Welcome right now. If you're joining the live broadcast, make sure that you hit us with a like, hit the like button. Also, do not forget to comment. Do not forget to hit us with a subscribe, follow the account. Okay, welcome to the live stream. So 5 things that affect the value of your money. All of these things can affect the value of your money, or some of these things, but these ones are the 5 main ones. Procrastination, we all know what it is. It's taking too long to make decisions, okay? Or being hesitant, or being driven by fear, okay? Or not being somebody who is disciplined to make good decisions in the proper amount of time. So that is procrastination, okay? Not having the confidence to be able to make quick decisions, and you wait until your money loses value. Okay. So the 8th wonder of the world, so the power of compounding. Okay, so this is which you initially, this is what investment is projected to look like. Okay, so you can see we've got the x-axis and the y-axis. On one axis we have value, on the other axis we have time. Okay, and you can see we've got red and green. Initial investment. Remember, the definition of investment is what? Allocating resources, but usually money. Yep. So there you go. So right now, initial investment, you can see, and then investment earnings. So you can see that the time axis is continuously going. So this is investment earnings that have been earned over a period of time. Okay, so you will still retain your initial investment, but due to the time factor. Okay, give me a second, guys. I just need to check something. Due to the time factor, it's compounded over time. So you see, that's what we talk about, the power of compounding. Okay, so the value of your investment is compounded over time. It increases over time. So you can see the value is raising. Your initial investment is raising, not instantly. It's rising, is not instantly. It's appreciating, not instantly, but over a long period of time. So if you are somebody who is serious about investment, you should be somebody who is serious about how you manage time. You should be a student of how you manage time. You should study time. Investments you will not reap the rewards of investment in a day. It will take some time. Okay. So this is actually, guys, giving you a projection of, or a picture of what to expect, of what investment is about. So in a nutshell, this is what investment is about. But in reality, probably this is not what investment looks like. But in theory, this, when we speak about investment, this is what we mean. Okay. Okay, just a second, guys. Trying to set up something here. So let's go now. So this is theory, and then beginner's guide to bonds and stuff. So usually when people want to invest, remember the other pictures, they were talking about your expenses, right? Your direct expenses, there's the saving expenses and other expenses like your food and your convenience and travel and stuff, and then investing. So usually when we talk about investing, when we talk about investing, this is what we mean. Okay, usually like we actually want people to invest in stocks or bonds. Okay, so we got the beginner's guide to bonds and stocks. So bonds are debt instruments, stocks are your equity. Okay, debts of corporations, governments, or other organizations, a type of loan borrowed from investors to raise funds for issuing an entity. Okay, so bonds is basically a company going to borrow from people, okay, and returning back that investment with some interest. Okay, so bonds is the company borrowing a loan from investors. Okay, and then they return back that loan with some sort of interest. Okay, there you go, per value or face value, initial price, coupon or interest rate. Okay, and then stocks or equity, these individuals can purchase shares of stocks, which represents ownership. Okay, so with bonds there is no ownership. With stocks there is ownership. Okay, you buy a stock, you're essentially buying a slice or a piece of the company. So you have ownership inside the company, okay, or what we call equity, or a fraction of the company, a piece, a part. So you become a partial shareholder or a partial stakeholder. So companies raise capital for various reasons. We all know that is how companies raise capital. They sell a stake of their company, so you become a part owner, and the money that you buy the money that you have used to buy a stake of that investment, that money, the company then uses it to what? To projects, expansion, and the likes. Okay. Company share price reflects the present value of a corporation's future cash flows and profits. Okay. And we also have capital appreciation, a rise in an investment market price. Okay. So an investment market price, that is capital appreciation, or the difference between the purchase price and the selling price. And then dividends. We spoke about these things. I've been talking about these things all the while. Okay, let's move on to the next one. Okay, let me just set up better here. My mouse. Okay, now let's go. What can you invest in? So you do have, guys, we've got a flow chart of what you can invest in. Okay, it's broken down as intangible assets, and you can see those are intangible assets. We do have bonds, we do have stocks, we do have brands, and the other side we have tangible assets. Okay, so we have, you can invest in tangible assets and intangible assets. Okay, intangible means that you cannot see them, you cannot touch it. Okay, but it's in existence. Tangible means that you can see it, you can feel it, you can touch it, you can point at it. So definitely we do not have, you get tangible assets. We're talking about your real estates, okay, housing and development, residential, land, real estate. When we talk about real estate, we're talking about residential. Real estate also covers land. Real estate also covers commercial land, okay, or commercials. Okay, we're talking about your shopping malls, places of commercial buildings where people work and stuff like that. Commercials, land, and residential. Residential is basically where we live. Land is just any piece of land, and also what commercial. So this is what real estate means. Okay, let me just lower my because the other part we cannot really see it. Okay, let me move it here. Let me lower it. I will adjust it later. Okay. Okay, there you go. And now we've got what? We do have also tangible assets. These are collectibles. We're talking about art. We're talking about equipment. We're talking about inventory. Okay, these are things that are tangible. You can touch them. You can see them. You can point at them. Definitely. Then we've got your intangible assets. Okay. No one knows what a stock looks like. No one has ever seen the stock. You cannot physically point at it or touch at it, okay? But it is a reality, okay? Intangible assets, we're not talking about your bonds and your stocks, okay? Okay, bonds can be corporate or they can be government, okay? Excuse me, guys, I'm under the weather. Okay, and then stocks, guys. We always have stocks, top right brands. Okay, stocks, we're now talking about your mutual funds or ETFs, domestic, global, small cap, large cap stocks. Okay, let's go. There we go. Now let's look at the history of stocks. The birth of the stock exchange dates back to the year 1300, and we are in 2023. So 1300, that is almost 800 years ago, 700 years ago, before you and I thought we could ever come and exist on this planet Earth. Okay, so 1300, Venetian moneylenders sell debt issues. So Venetian, from Venice, Italy. Money lenders, okay, you know, money lenders, these are business people, sell debt issues. This is 1300. And then in the 1600s, European governments, okay, invest in East Indian companies. This is the age of, this is the Renaissance. This is when European governments or European nations began to start to move out of Europe, going, discovering new lands and trying to invest in those lands, various investments. European governments invest in East Indian companies making long sea voyages. So now we see a lot of trade going on. The British are going all over the world. The Spanish are doing the same. The Portuguese are also doing the same. They're discovering new lands. Maybe according to them, these are new discoveries, but these places had always been there. Okay, so they're making long voyages, trading and carrying stuff, coming to places like Asia, going to places like Africa, going to places like North America and South America, you name it, anywhere in the world. Okay, so 1773, London Stock Exchange is officially formed. Okay, so the London Stock Exchange has been around for a very, very long time. So LSE is officially formed. That is in 1773. Now let's go to 1790. Now in the US, the first US stock exchange opens, the Philadelphia Stock Exchange. So you can already see that markets like London, like the UK and the US, they are ahead of everybody in terms of the stock exchange. Look how early they opened their stock exchanges in the 1770s and in the 1790s. Okay, so Philadelphia was the first stock exchange in 1790, and in the UK, London Stock Exchange was the first one in 1773. Okay, now we go. There's no major development. The 1800s are quiet, but now we get into the 1900s. Okay, 1923. Okay, most of us were born in the 1900s, I think, or in the early 2000s. The early version of the S&P 500 is created and begins tracking 90 stocks. Okay, so these are indexes. If you know anything about the stock exchange, you do know that the SP 500 is an index that is used in stock trading and stock exchanges. One of the ones that they check up on. The early version of the S&P. So this is the early version. It means that the S&P has, of course, been updated. Okay, so that's 1923. 1971, trading begins on the NASDAQ exchange as well. That is in 1971. And now we are in 2024. So stock exchanges have a long history. Maybe I'm thinking on my next live, I can actually create a much more detailed a much more detailed presentation about the stock exchange. I might come up with that. I will have to see. Okay, let me go now. Let's move on to that. Okay, so there we go. We have a graphic over here. Markets often climb mountain of worries. Okay, so all these are historic events. As you know, markets respond to world events, especially catastrophic world events. So you can see right there, attack on Pearl Harbor that happened in 1941. So you can see over there the graphic there. This is the stock market is the blue line, and also you do have your x-axis and your y-axis as well, and also under there you do see there are some numbers: 40, 50, 60, 70. That 40 is 1940, 50 is 1950. So that is a timeline from 1940 to the 2020s. Okay, so this graphic over here is kind of highlighting some of the major historic events and how they impacted money markets, or how they impacted the what the money markets and investments. So 1941, attack on Pearl Harbor, and then 1950 the Korean War, and then in 1960 we have the Kennedy assassination. But you can see the graph is still going up. Okay, and stocks are rising. Okay, stock prices are going up for some weird reason though. And then we also have the Nixon resigns. Yeah, we do have President Nixon. He resigns in 1974. And then also we have financial panic of 1987. Exactly 1987. So it's 1987, it goes down, and then we have the Gulf War, when, of course, Saddam Hussein invaded Kuwait, and then the U.S. had to come in there as well. That is 1990. You can also see that response by the market there, and then we have the infamous September 11 terrorist attacks on Washington in the United States, the World Trade Center. So obviously that impacted the markets heavily because they targeted the World Trade Center, okay, where all the world trading happens. This is what the terrorists targeted, and the market felt it. Okay, the market felt it. There was a dip in the market. Okay, it went under. And then also Lehman bankruptcy, that is 2008, and also the whole crash, the downturn of the economy in the 2008. We also have the U.S. debt downgrade by S&P. Then we have 2016. We had the Brits exiting, what they call Brexit, and also COVID-19 pandemic, 2019, 2020. So markets are actually affected by all these historic events and all these things that happen in our daily life. And usually they actually cause stock to rise or fall in prices, okay? Because when usually things of a traumatic nature happen, then fear comes in. It makes people be fearful, people not to want to invest and lose their money. So that is just a natural response, because usually people want sanity, they want peace and quiet. Whenever there's something that is catastrophic, like a war, an assassination, pandemics, Brexit, people living and stuff like that, it breeds a sense of untrustworthiness. Okay, people are not going to trust. People are not going to want to invest their money. People are going to want to take back their investment. Okay, because it seems like everything is leading towards some demise, or it's leading towards some loss. Okay, we all want to get a profit when we invest. We are not really looking at loss like that. So yeah, so there we go. So that's historic as well. So bear markets interrupt bull markets. Okay, let me adjust my thing there. Bearish behavior. Bear markets interrupt what? Bull markets, federal funds rate. This is another graphic there as well. You can see your bear markets are the green, and the bull market is green. So that's bullish. The bull has horns, right? A bull has horns. So it's kind of using those horns to to go up, that motion. Bull market's always been buying stocks and going up and bidding for stocks. Bear markets are the opposites. We also have our recessions. A lot of people do not want graphics on the live stream, unless if it is a live graphic reading, we can do that. But this one, you can see, is just a comparison between bear markets and bull markets, and how bear markets interrupt what? Bull markets. Okay. So E is expansion and R is recessions. Okay, let's move on as well. Okay, 3 key lessons from history. So we got 3 key lessons from history. The unexpected can and will occur. Okay, so this is something that every investor should understand. Okay, the market will always behave how it wants to behave. The market is, no one has figured out the market. Okay, no one in human history has figured out the market. The market is its own organism. It behaves the way it wants to behave. So anything unexpected will and can occur. Okay, there is a high probability that it's inevitable for something unexpected to happen. Okay, like we did show you the graphic with all those world events, world history, world historical events. The unexpected happened. Okay, markets are cyclical. Markets are a cycle. Markets do not always remain on the upward trend. Markets also dip and they go up. So it's cyclical. Okay, it's cyclical. Okay, it's there's volatility. It's an up and down, up and down. Sometimes there might be stability, but as you heard from the first point, the unexpected can and will always occur. Okay, because of those events that we have happening. Okay, unexpected events. Historically, markets recover. Markets will recover. Okay, just like you go to the gym, you work out at the gym, you get tired, there is a space, there is a time that you call recovery time, right? You need to recover, you need to get back your strength. It's not advisable to always be lifting and work your off. You also need to have recovery time. So even if markets crash, markets will recover. Okay, so they can be uncertainty. Markets are a cycle, and if they crash, markets will always recover. So how do we know this? Because we have history. Okay, we have history. How do we know this? Because we have a track record of the behavior of markets. Okay, so that's nothing to be startled or to be surprised about or to panic about. This is how the markets always behave. Okay, fundamental principles. Yep. This is our what slide is this? We do not have a lot of slides today. Okay, this slide. Okay, we still have more slides to go. Fundamental principles. Okay, let's check this out. Create goals for your money. Okay, you should ask yourself these questions. Okay, what for, how long, how much, what's next? Create goals for money. What's your money for? Okay. How long do you want to hold on to your money? How long do you want to invest? Okay. Are you in investment for 5 to 10 years? Are you in investment for the long haul? How much are you going to invest in your money? Okay. Or how much are you going to spend if you're not an investor? How much are you going to save if you're not into investing? Okay. And what's next? What's next from here? Okay. Now that I've saved my money, I've taken care of my taxes and my bills. and I've taken care of my immediate needs, and I've invested. What's next? What's the next thing? So your money, you should always create goals for your money, okay? Your money relies on you for its own success. Okay, let's move on. So there you go. Create goals for your money. So these are some of the questions that you should ask yourself, because you grow old, okay, and time is never on your side. Uh, so there, let's go. Okay, invest early in life. So when it comes to investment, you want to try to invest early in life, because remember, investment is a destination, okay? Okay, investing is a journey, okay? It's not a destination. Investing is a journey, it's not a destination. So definitely, there you go. Okay, let me open something here. Give me a second. Yeah, so try to create goals you can ask yourself. So invest early in life. Okay, invest, start saving early and stick with your plan. So you could have a plan. When you invest, you should also have a plan and stick to your plan. It's a time tested strategy for investors seeking to build wealth. A head start in just a few years can make a big difference thanks to the power of compounding returns. Remember that graphic that I showed you, compounding returns. Staying invested can offer more growth potential. So you want to invest early, okay? So that over time your investment will be subject to the power of compounding returns, okay? You want to start maybe in your 30s and have, because for surety your investment will have over 30, over 20 years, your investment will will um will appreciate in value, okay? So there we go. Capitalize on growth potential and the power of time. Okay, growth potential and the power of time. So when we are investing, some of the things that prompt us to invest are growth potential. Okay, is there potential for growth? Okay. Okay, so we are willing to buy risk into a company that has potential for growth. Okay, so you should have be able to forecast, okay, which direction and where a company is going. Okay, so there you go, investor A, investor B, and investor C. Okay, so investor A, this is just an example. Use the rule of 70 to your advantage. Okay, investor A, 5,500 per year, invests for only 10 years, 55,000 invested. Okay, okay, so a year. So every year this person has been investing 5,500. So they've invested 55,000 in a year, okay? And so also got the age as well. And at the end, balance at retirement, they've invested 55,000, and then at retirement they are having $1 million. Okay. Investor B, initially for the first 10 years, investor B did not invest in anything, but then investor B begins to invest the same $5,500 and invest them for 34 years. Okay, so $5,500 a year for 34 years, and that is 187,000 invested, and they only get 872 dollars. Okay, and then we have investor C, who's been investing $5,500 for 43 years. So their total investment is $236,500 invested over 43 years, and you can see that the what that is 1,812. So you can see the graphic here. It shows one person at the top invested for 10 years, for only 10 years, maybe in the stock market, I don't know, but for the remainder 33 years, they didn't invest. And then another person came, and for the first 10 years, they didn't invest. And then for the last 34 years, they invested. And then the other person has been investing consistently for 43 years. So these people, they didn't invest at the same time, but they used the same amount of money investing at different intervals. And then you can see balance at retirement. So who would you rather be? Would you rather be investor A, investor B, or investor C? Okay. Would you rather invest for 43 years and make an investment of 236,500 and get a retirement package of 1.8 million, or you'd rather just invest for 10 years and get $1 million? So it all depends. Like we did say, guys, it's not a what? It's not a one size fits all, but it's always advisable to what? To always start early, okay? So it depends with your understanding as well. So this is a really good graphic. You guys, I hope you like that. You can say, I hope it's big enough. Let me see if you guys can really see it. Yep, exactly. You can really see it's really big. There you go. Balance at retirement. Okay, so definitely you do not want to be investor B because if investor B had just been had started 9 years previously or started 10 years previously, investor B would have made $1 million more. Because how do we know this? We can check out from investor C, who invested for 43 years and got 1.8. Investor B invested for the same amount, they would have ended with $1 million more. Okay. So let's go. Now let's understanding saving versus investing. Okay. Give me a second, guys. Okay, let's move on. Understanding saving versus investment. These are two terminologies that people usually confuse. So there we go. Understanding saving versus investment. Okay, so saving inflation. Okay, saving is subject to inflation. Investing, you're creating value for your asset. Okay, and you are purchasing financial assets. Okay. So there you go. It is also important to understand saving versus investment. Remember to prioritize an emergency fund and choose the most effective investment vehicle for your goals. Okay, prioritize an emergency fund. Okay, choose the most effective investment vehicle for your goals. Okay, we did talk about investment vehicles. Investment vehicles are also asset classes. There's so many investment vehicles. Are you going to be investing in cash? Are you just going to invest in stocks or in bonds? Okay, so you choose what you want to invest in. Okay, and remember, guys, with every investing that you do, you will need financial advisors. Your brokers are your financial advisors. Okay, so know your risk. Okay, we're now knowing your risk. Okay, it's important to know your risk. Now you're an investor, know your risk tolerance. Okay, so we have conservatives, we have moderate, and we have aggressive investors. So in this example, we just used two. We just used two investment vehicles. We have stocks and bonds. Okay, so know your risk tolerance, learn the risk associated with different investments. So you should know the risk associated with investing in stocks. You should know the risk associated with investing in mutual funds. You should also know the risk associated with investing in bonds. Okay, so you should understand. Okay, do not allow anyone to understand this for you as an investor. You should try to have an understanding of what you are investing in. Okay, assess your risk comfort levels and determine the type of investor you are. So, yep, comfort levels. You should assess yourself. What kind of an investor are you? Okay, are you gonna have more of your investment in bonds and less of it in stocks? Are you going to have or like a 50-50, or are you going to have most of your investment tied in stock and a few of it or less of it tied in stock? So it's up to you. So tell me this is how it works like. So you can see you got some graphics there: conservative, moderate, and aggressive. The aggressive investor wants 80% in stock and 20% in bonds, because stock, remember, stock, you hold on to risk, you buy assets, you are an owner. Okay, your investment, because of the power of compounding, your investment will get some investment returns. Bonds also are of a similar nature, although you do not own any financial assets. But with bonds, you're definitely getting, you loan out money to a company and they will return it back in with interest rate. That is what we call a bond. So you got to understand the product, you got to understand your different investment, you got to understand what you're comfortable with. Okay, so these are the types of investors. Are you moderate? Are you conservative? Are you aggressive? But all this, guys, is made possible with experience over time. Okay, initially you're not going to understand if you're not in the industry, but then over time you will start to master and understand. Okay, let's go again. There we go. Reduce risk as you get close to your goals. Okay, reduce risk as you get, it's not advised to keep on carrying risk even to the finish line. Okay, when you see that you are within reach of achieving your goals, try to reduce risk. Okay. So reduce risk as you get close to your goals. Okay, the more risk you take, the more returns. Okay, so let's go to stock bond allocation years to goals. Okay, 35. Oh my God, that is so allocation guide as well. So this is just self-explanatory. Okay, reduce risk as you get close to your goals. Okay, some things I do not have to say them; they are just, because remember, guys, this is an intro. Okay, as you approach your goals, consider adjusting your risk levels to stay on track. Okay, risk is the reward you get for investing, but try to reduce it as if your um, investment goals are within reach. Okay, stay invested. Stay invested. There you go. So investors who stay the course, investors who make it all the way to the end can get some benefit. Okay, so stay invested, take advantage of time, not timing. Okay, that is important, and be disciplined and do not miss the market's best day. So an investor is somebody who has an in-depth understanding and appreciation that they are an investor. This is their job. An investor takes time to know about their investment. They talk to others, they research, they look for information, they do a lot of reading. Okay, investor is someone who is keeping track of their investment so that they are up to date with whatever goes on, so that they are also informed. Okay, you want to stay informed, especially if you are an investor. So you can see from the graphic there, stayed fully invested, 10.66 annualized total return. Okay, 10,000 invested, and we have from 2006 to 2021, 10,000 invested in an SP 500. They stayed invested and they were earned what 45,000 from just 10,000, which is good. And also missed 10 best days. Okay, the next person missed 10 best days. Okay, missed 10 best days. Like we did say, don't miss the market missed days. So they missed 10 best days and they fell short of, so they missed out on 20,000. And missed 20 best days, missed 30 best days, missed 40 best days and only earned 5,000. Okay, missed 10 best days and only earned 20,000. Okay, for their investment. They missed 20 best days and they earned 12,000. Okay, so you can see if you miss out on the best days, that means you're missing out on an opportunity to cash in or to improve your investment. Okay. So this data, guys, is historical. And then we also have to diversify our portfolio. We always talk about this. I think this is the umpteenth time of me talking about a diversified portfolio. So you can see all these graphics. I know most of you guys do not understand them. You can see, but it do have some indicators: large cap growth equities, small cap growth, mid cap, core equities. We did talk about large cap equities and medium and small cap equities. We spoke of that last time. I do have a live broadcast that I did on that. If you want to understand what large cap, mid cap, and small cap means, please go check out one of the live streams. I did speak on this subject. And small cap equities, there you go. So let's move on. Next steps. Okay, so there we go. This is our next step. Buyer beware, okay? Not always insured by a Federal Deposit Insurance Corporation. Be wary of promotions for the best or no risk investment, okay? All investment carries risk. We can't really say that there is the best. There can be a best time, but there is never the best investment. Okay, but they are better investments. Okay, be careful who you take advice from. Okay, yep. We always try to encourage you guys that I'm not a professional or anybody like that. I'm also an investor. Usually, the motivation behind doing this live broadcast is for you guys to excite you, to ignite you, to inspire you to begin considering or pondering upon trying to invest or create greater wealth. Okay. So here we're not really giving you takes, or we're not saying go buy this stock, do not buy that. We're just talking about investment in general. Okay. We're not prodding anybody to go buy this or drop that. No. It's just to help you understand that you're missing out if you're not investing. And once we push you, then also you can also start to research for yourself about investment, whether investment is best for you or it's not. Okay, because investment is not for everybody. Okay, key takeaways, let's go with that. Key takeaways and action items. Okay, these are our key takeaways and action items. There you go. Understand saving investors investing. Start early, stay invested, and be consistent. Okay, if you're going to be an investor, start early. Okay, start in your 20s, start in your 30s. Okay, you don't want to start investing when you're 70 years old. Okay, or 80, or even 60. You want to start if you're going to be late, maybe 40 at 40 years old. Okay, at 40 years old, be sure if you start investing at 40 and you live to be 80 or 90, you will be able to enjoy your investment. Okay, understand saving versus investing. You start early, stay invested, and be consistent. Investing requires consistency. Okay, investing is a lifelong learning process. Okay, we do not only learn something today and we become investors. Investing, being an investor, is learning every day. It's kind of like a curriculum or a syllabus. You gotta keep on learning. There are new investments out there. Okay, so you're not only learning about your investment, you're also learning about the potential opportunities that exist in the investment world. Okay, so keep learning. Markets in Minutes podcast, research, market commentary from industry professionals. You should keep on learning. Okay, consider working with a professional. Stay connected to your family advisors. It's important for us to work with professionals. Maybe we do not know, we do not have the knowledge, but there are people with knowledge out there that are financial advisors, investment advisors, or managers. Let's make use of those people, okay? So we've reached the end of our live broadcast. Um, Thank you for watching it. We'll see you next time, guys.